The objective of this lecture is to summarize some key metrics of stock investments and valuation and help investors make informed decisions using a relatively simple framework. There has been a plethora of information on stock investing, regularly bombarded on investors by financial media. This flood of information is disseminated by multiple media channels. Some of these industry resources provide valuable information, yet these reports may not help in making informed decisions. Studies have shown that Value Line, with its highly sophisticated analysis, can hardly compete with the market index. Research has demonstrated that beating the market index needs superior analysis and right timed execution. The term used for this unique skill is alpha, and some examples of alpha seeking gurus are Warren Buffett, George Soros, Peter Lynch, and others. Before delving into a more pragmatic framework of stocks, it is important to define different categories of stock investings. Stocks are broadly categorized as either common stock or preferred stocks. The key difference between the two is characterized by the following. First, preferred stocks are preferred, as the name implies, over common stocks in terms of claim by the shareholders in case of default by the company. Second, preferred stocks are purchased to get dividends income with less potential for appreciation, while common stocks may be used for both dividends as well as capital appreciation, with focus on the latter. Third, preferred stocks behave like bonds in some cases. As interest rates go up, the price of preferred would typically go down. Interest rate variation has some degree of correlation with stock market as a whole because as interest rates go up, the stock market gets hit. For individual common stocks, interest rate variation effects will depend on a number of factors, in particular the capital or debt structure of the firm. Other categories of common stocks include: first, blue chip stocks of well reputed Dow Jones companies with established history of dividends payments to investors. Second, value stocks are undervalued gems likely to grow in the long run. Third, growth stocks, as the name implies, are growth oriented stocks which are priced higher because of their perception of appreciation in future. Fourth, cyclical stocks which are sensitive to swings in the business cycles. And fifth, stocks which stay calm during market swings, such as utilities. Now, coming to the key metrics of stock investing, let me summarize these metrics as follows. Number one, 52 weeks high low. Find out the price of the stocks prevailing in the stock market and compare the current price to past 52 weeks of high and low prices of the same stock. The idea is simple. Stocks having lower price range in the rising markets have greater upward potential than stocks which have already reached the 52 weeks mark. Number two, market capitalization. This metric reflects how big the company is. Market capitalization is obtained by multiplying the number of shares outstanding of the company by the prevailing market price. Typically, stocks are classified as large cap, mid cap, and small cap stocks. Large cap stocks like Exxon and Coca-Cola generally do not have a great upward potential of price increase as compared to some gems in this category of mid cap and small cap stocks. The latter category of mid cap and small cap stocks has the highest probability of representing emerging star investments, which typically multiply and grow tenfold in a certain time period. Number three, volume. This metric tells us how much dollars are being traded on a single day. Volume is computed by multiplying number of stocks in trading on a particular day by the average price. Blue chip stocks like Exxon, Microsoft, and Apple have large volume. In contrast, small and mid cap stocks have smaller volume, thereby creating some liquidity risks.